I'm Hilary Hendershot, your host, and this is Profit Boss Radio, episode 124. Profit Boss Radio is your weekly wealth mastermind. Profit Boss is also a community and a movement for women who are ready to take control of their money, break the glass ceiling, and give ourselves permission to finally have enough. Want the secrets of wealth to be yours? This is the place. I'm Hilary Hendershot. I'm a certified financial planner running a leading advisory firm for women, and I'm sharing with you real stories from real life and real women who are making it happen. Forget Wall Street. Let's do this, ladies. A brief PSA here. We are going to be talking about investing. I'm going to be talking about how I think about selecting investments, and I'm specifically going to be talking about the investment solution that I've selected for Ignite clients. So I run a program for investors with between $25,000 and $499,000 to invest called Ignite Investing. If you listen to this podcast, you've heard it promoted. And I also work with high net worth investors who have $500,000 and more to invest with a traditional comprehensive financial planning model. However, the investment solution we're specifically going to be talking about today is the one I use in the Ignite program. Okay. So I want you to promise me something. You are not going to take this discussion as customized, individualized investment advice. If I don't know you and you're not my client, I'm not recommending this for you. I have not considered you, your goals, your income, your assets, your time horizon, your risk tolerance, okay? If I don't know you, you're not my client. This is not an investing recommendation, okay? So please take all this with a grain of salt. It's meant to be educational. I work with Ignite clients in a comprehensive advisory relationship. They get recommendations from me and my team on every aspect of their financial life, including insurance and estate planning and income tax. And that way we help minimize the chances that any kind of financial mistakes can get made. And obviously anything can happen in the stock market. So please, again, don't buy anything based on today's conversation. Thank you. Welcome to this first episode of Ask Hilary in season 3 of Profit Boss Radio. We've got some great questions for you. You can submit questions of your own by just picking up your mobile device, hitting record in the voice record app, and asking your question. I'd love it if you'd say your name and the city that you're from. Send that question to media@hilaryhendershot.com, and we'll answer it on the next episode of Ask Hilary. We'll be doing these episodes about a month apart. So today we've got questions on why it's great to be a business owner. So reasons to consider being an entrepreneur. We have questions on how to manage cash flow and budget if you don't think you have enough to max out your retirement savings, like I've talked about before on the show. And then we have a couple really great questions about the stock market. So some of you are hearing some of the cool things that companies are doing, and you want to know if you should invest more in those companies. And also I got a question from an Ignite client who wants to know, why did I pick the balanced mutual fund that I did? Why did I pick that investment for Ignite Investing versus any of the other options that are out there? And I'm excited to answer all those questions. So let's get right to it. First question is from Nikki.
Hi, Hilary. I remember hearing once on an interview on one of your podcasts that it is a good thing to have a side business simply for the sake of tax season. And I do have a small side business that I've just done. I love calligraphy, and so I've done calligraphy and wedding signs. But I'm wondering how I can take that and use it to my advantage during tax season. Can you help clarify that? Thanks.
Hey, Nikki, great question. First of all, love your voice, girl. You got a voice for radio. Second, calligraphy as a business. Yeah, I'm impressed. I make great block letters. But calligraphy sounds like you got to have some fine motor control to do that. Okay, so proud of you, and that's exciting. So let's talk about some of the things that make being a business owner great, or having a side hustle. So first of all, to the extent that you do have business income, you can write off all that income against business expenses. So for example, let's just say for the sake of discussion that I host parties, or I plan parties, and I make $10,000 in a year to plan those parties. Well, if I have $10,000 of business expenses, I can actually not pay income tax on the $10,000 of income that I earned. But the income has to come from the business, and the expenses have to be attached to the business. So some things that most people pay full price for that entrepreneurs can deduct from income or deduct against income are business trips. So if the nature of your trip is developing you as an entrepreneur, you're learning, you're at a workshop or a seminar, you're seeing clients, you're with a business mentor, well, then that trip is actually a business expense, and you can deduct it from your taxable income. Also, there are lots of different ways to account for the use of a vehicle in a business, or the use of a vehicle by you for business purposes. So some of your wear and tear on your vehicle and some of your gas is going to be a deduction. That question is for your tax planner. So how to exactly do that is for your tax planner. Any kind of personal development that you do, seminars, trainings, books, lots of coaching, things like this. These are all tax deduction as an entrepreneur. Your computer, your laptop, and, as we all know, I don't even know what word to use, but you got one laptop and you're using it for your business, but of course you're also going to use it for your personal. I mean, you don't necessarily need to buy a separate computer as a personal expense. So if you're able to buy that computer as a tax deduction, it has benefits for you personally. In the same way, you're the entrepreneur. You go on that trip to Dallas or Washington, D.C. or Seattle or San Francisco, and, it does develop you as a business owner, but it's also enjoyable for you personally. So there are like these ancillary benefits on the side of being able to do things at a tax deducted rate. And let's just talk through, it may seem obvious, but let's just talk through why being able to write off expenses is valuable. Well, the net of it is you get about a 25% discount on everything you deduct. So if it would have cost you as an individual $100 to buy something, but instead you buy it as a business owner and you deduct it against income, depending on where you live and the size of your mortgage and other aspects of your tax return, most people are somewhere in the 18 to about 24% net effective tax bracket. So just lop off 18 to 24% of that purchase price, because that amount doesn't get taxed as income. And now that's your actual financial impact on your money. So if you have to pay taxes on it, cost you $100, versus a situation where if you're an entrepreneur, let's say you're in a 20% net effective tax bracket, well, that thing that would have cost you $100 only cost you $80. That's a pretty serious discount. So let's say you love snowboarding and your snowboarding trips are really expensive. Well, if you have a snowboarding website where you make money on advertisements placed on the site, you can now deduct the cost of all of your snowboards and snowboarding trips, but only to the extent that you have business income. That's kind of cool, right? Some of you are in the equestrian business, so horses are a really expensive activity. Well, if you can start a horse equestrian website and make money on it, well, now you can pay for your equestrian activities with business income and you can write it off. So bigger picture, why it's great to be a business owner. Well, you're the author of your life. You literally paint the canvas of your life, who you interact with, how many hours you work, when you arrive at the office, all of that. You control your schedule and your calendar, which, as we know, is a huge determinant of people's satisfaction and fulfillment in life. Your entire life is one big tax deduction. As I said before, a lot of the money you spend investing in your business, you also benefit from personally. I'm going to be going to Las Vegas with my employees in a couple weeks, and that's for the all hands planning meeting. I have to fly people in because Jen, who works with me in Ignite Investing, she's out in Indiana. And so no matter what, there has to be a plane ride involved. And we're meeting in a place that it's cheap to fly to. That's Vegas. I think our plane tickets cost to fly from San Jose to Vegas for Chris and me was $100 each. Super cheap. So we're going to meet in Vegas. We're going to spend a day planning and a day playing, and the flights and the hotel are a tax deduction. I benefit from that personally. Yes, in the new tax environment, business owners do have a significantly reduced ability to write off like restaurant and bar meals. But again, that's another question for your tax advisor. So let me caveat all this by saying that I find that a lot of business owners struggle to pay themselves a high income. I mastermind with a lot of business owners, and how much we pay ourselves is a constant topic of discussion. But if you can get to a place in your business where you're paying yourself good income and saving a lot, the world is your oyster. So I know maybe easier said than done, but it can be done. Of course, if you hate responsibility and you're going to just suffer about how you really do have to handle all the details, then just forget this whole business owner thing. Just get a 9-to-5 where you don't have to take your work home with you. Because, as the business owner, I'm responsible if the wheels fall off. I'm 24/7, 365 in reality. So I hope that gives you a sense of some of the things I think are great about possibly having a side hustle or maybe being a business owner. I do think it's a bit of a different mentality. I think that I have adopted the mindset that anything I do that develops me is in the name of both my personal life and my business. So I'm very interested in having a high quality life, high quality experience of my day. I value my time. It's just a very different mindset. And so it's something that I really enjoy. And if you are considering it, I think there are lots of good reasons to do that. And here's our next Profit Boss listener question.
Hi, Hilary. This is Carrie from Nevada City, California. I have been doing the math over and over again. I've listened to a lot of your podcasts, and I'm wondering how I can do it all. How do I save for both my husband and my 401k? How do I save cash for just in case? And how do I save for our retirement fund? I did the math, and that's about $40K a year. And that's a lot of money not going towards bills, mortgage, etc. So I just am confused about the advice. I just need a little bit of help organizing it. I've gotten a really long way, but I'm kind of stumped at how to make all the parts work together. Thank you. Love your podcast.
Yep. Carrie, I totally get it. First of all, I actually know Nevada City, California. It's a teeny little town kind of en route to Lake Tahoe, and I have spent some quality time there. Super cute little downtown. It's a former logging or gold rush or mining town. I love it. I love it. And I think, if I'm not wrong, you don't have the kind of income potential living in Nevada City that you do in a major metropolitan area like San Francisco or San Jose or Chicago or Dallas. Okay, so I'm guessing what's happening here is that you've got an income that's appropriate to Nevada City, and you've heard some of the numbers like I've said on this show. Oh, max out your 401k at $18,500 a year. Well, that's all fine and good, except if you're only making, $50 or $60 or $70,000 a year, well, then those numbers are going to change a little bit. So I don't know your income, Carrie, okay, but I'm going to give some numbers, and I just estimated. I don't know if you are married or have dual income. I don't know anything. So I could do a better job of this if I had a number, but I just picked $80,000 a year of income. And so the important thing is how you plan to spend those dollars. So $80,000 a year is $66,66,67 a month. You always want to translate from monthly or from annual to monthly. So because most expenses are monthly. Okay. So let's say your rent is $1,500. First thing we do is overhead. That's what in my automation system I call yesterday's promises. So let's say you've got $1,500 a month for rent. That's $18,000 a year. another $250 for subscriptions, gym memberships, other stuff that you pay for on a monthly basis. That's $3,000 a year. Let's say your utilities are about $150 a month. That's $1,800 a year. Okay, so that's a total in the yesterday's promises category of $22,800. Oops, I forgot taxes. Okay, I didn't forget them in my math. So let's circle back to that 80K number. And let's say you're paying 15% combined federal and state income taxes. And you can actually calculate that number by looking at your tax return to see what you have paid historically. Many of you know that that number may change slightly in 2018 after the Tax Cuts and Jobs Act. But for purposes of this estimate, I said, okay, this person, Carrie, maybe, is paying 15% tax. And so she had $80,000 of income, $15,000 or 15% of that is $12,000. So she's got $68K remaining. Now, remember we said her yesterday's promises or overhead number was $22,800. And that leaves $45,200 to plan for. Now, here's where little changes can make a big difference. So instead of planning for more spending, here's where you want to plan for savings. So let's say you have an employer-sponsored 401k and let's say you saved $12,000 in that 401k. Now look if you can't afford 18.5, don't do 18.5. It's okay. Your income will probably go up over time and you can save more later. But the important thing is to get started saving now and also to not go into debt. So let's say you're saving $3,500 a year to take vacations and you're saving $7,500 a year for your next car. Remember, I want you to save money so you can pay cash for cars so you don't have an auto loan. Okay, so I call that tomorrow's dreams. You can also think of that as savings. But so we had $12,000 in a 401k, or maybe if you don't have a 401k, you're maxing out your Roth IRA. I think that's $5,500 in 2018. And then you have some money that you can still save. So if you want to save a total of $12,000 in a year towards your retirement, you don't have an employer-sponsored 401k, you can put $5,500 in a Roth IRA and then do the remaining $6,500 into a brokerage account or an after-tax account. So that's still $12,000 a year for retirement savings. Vacations, the calculation of that number would be a little different because if you're going to put money into a brokerage account, it's actually after-tax money. So you have to take the tax amount out. But anyway, $3,500 for vacations and $7,500 for your new car. That's $23,000 a year for savings, and you've got $22,200 remaining. And then you just take that number and divide it by 12. And that is your today's fun number. And for this calculation, that's $1,850 a month. And that's how much you can spend on gas and in restaurants and on clothes and on things you want in the moment, in the coffee shop, little tchotchkes, little ancillary expenses, things that come up, right? Going out with friends, things like this. That's what you've got remaining in your budget based on this calculation. And then you can kind of play with the numbers from there. But again, the important thing is to first minimize your expenses, your monthly expenses, what I call yesterday's promises, then be strategic about tomorrow's dreams, and then spend in the today's fun category what's remaining. If you want to dig deeper into some of the categories that I talked about and haven't heard about financial automation yet, go back and check out episode 84 of Profit Boss Radio. All right, here's our next question. I actually got a couple of questions about stock market investing in the last couple of weeks, so I decided to combine them into a little mini lesson about stock investing. So this first question is from Malaika in New Orleans. Okay, don't hate me if you speak French and my accent is terrible. I only claim to have a decent Spanish accent, but I love saying New Orleans. It's so beautiful. It's like the name Jennifer in French is Jennifer, which is like gorgeous, right? So anyway, enough about New Orleans. Malaika says, Apple the company, is making a serious alignment with healthcare and with the healthcare industry. Should we buy some of that stock? And Malaika is an Ignite client, so it's inappropriate for her to ask me if we should buy some Apple stock. Okay, so first response, This is like exactly what Malaika is thinking and feeling. She's looking at the news, seeing Apple is doing all this cool stuff, expanding what's possible with an Apple Watch. And now people are going to be able to see their heart rate, their red blood cell count, their white blood cell count, all their various pieces of critical health information on their Apple Watch. And it's like, okay, Apple Watch is going to get embedded with a whole new community, the healthcare community. So it seems like the market is going to expand, profits are going to take off, and we should own some Apple stock. This is the siren song of active stock picking, okay? This is the very human trait or tendency that Wall Street capitalized on for so many years and took so many dollars off the average Main Street American, siphoning them from your accounts to theirs. Okay. So my first response is that every one of you should own some Apple stock. What Malaika maybe didn't know, I don't know, she knew it, but she already owns Apple stock because she's in a balanced fund. Apple is the largest market cap company in the world. So every single diversified portfolio, balanced portfolio should have some Apple stock in it. It's the largest company in existence. You already own it. Okay. And, I get to see lots of people's portfolios when folks come in to my office. They've obviously got their money invested in something. And I can't remember the last time I saw a portfolio, without Apple. Like I said, it's the biggest company in the world. So second response is that unfortunately, if you know about it, she said, look, this thing is happening. Apple Watch is aligning with healthcare and the healthcare industry. So she read that in the news. She heard it on a podcast or on the television. She found out about it. The information was released publicly. She heard it. She processed it, thought about it, tossed it around, and then asked her financial advisor about it. If you know about it, it is way too late to profit from it. Now, this is why insider trading is illegal, okay? So if you have inside information, that's the time when you can profit from information because the public doesn't know about it. But if the public knows about it, then analysts have already fully integrated it into their expected value or the new or expected value of that company. And the stock price has already changed. And I know that is really hard to sort of grapple with. So I used this metaphor with my 50K wealth multiplier experience people. We did a whole day, a half day on stock market investing. And I used this metaphor. I'm kind of proud of it. So I'm going to use it here. Tell me if it works. So imagine you live in a small town and there are kids that keep throwing parties. And so let's say the Smith parents go out of town and the Smith kid throws a party and all the kids in the town come over to the Smith house and they all party. And the Smith parents come home and they're really ticked off. Well, their house is damaged. They got to clean the carpets. There's beer bottles in the Let's say the Buchanan parents, they're going to go out of town and the Buchanan kids, they plan a party and they start inviting people. But some of the people that get invited are these moles who are on the side of the parents. And the moles go to tell their parents that the Buchanan kids are going to throw a party. Well, the parents call the other parents and the Buchanan parents get called. And now everybody knows that there's going to be a party. The Buchanans never go out of town. No party happens. Okay. So now let's say this happens 10, 15 times. Various sets of parents want to go out of town. The kids plan a party. The parents find out about it. The whole thing blows up, right? Now, the sneaking a party in your parents' house market has kind of dried up, right? You can see the impact of this is pretty soon what's going to happen. Kids aren't gonna throw parties anymore. Okay. So that the nature of public information is that everyone acts on it instantaneously. So in this case, the kids trying to throw the parties are the ones in the stock market trying to act on the information they think they have that means something to the price of the stock. But the kids who are the moles, the ones who are broadcasting the information to the parents and the kids and everybody who needs to know, those are the stock analysts and the members of the financial news media who publish what all the information that we have about companies is public. That's the nature of a company being public, right? So they make press releases, they talk about plans, they have quarterly earnings reports that they do, right? Lots and lots of stuff about publicly traded companies is known. And then there are always hundreds, if not thousands of people desperately trying to trade opportunistically on that information. And as you trade opportunistically on information, as more and more people do that, well, the profit opportunity there gets to be less and less. And the fact of the matter is, unless you're a professional stock trader or analyst or mutual fund manager or hedge fund manager, you cannot possibly react quick enough to act profitably on new information. So unfortunately, if you and I and ordinary Americans have the information, it's way too late to trade profitably on it. Instead of trying to decide which companies you should own based on how you think they're doing in the market, what I recommend, what I've talked about a lot on this podcast, is something called market-based investing. Just buy all the companies rather than you trying to be a company analyst and decide which companies are going to go up and which companies are going to go down and buy the ones that are going to go up before they go up and then sell them before they go down again. Rather than trying to do that, because it turns out even the highest compensated mutual fund managers out there can't do that profitably over the long run. You just get to buy a balanced portfolio, which is what I build for my clients, which is what we have in Ignite Investing, which is what I build for my high net worth clients as well. And then you hold on because stock returns are random. I mean, how many of you remember when Apple stock was like, I don't know, the redheaded stepchild? I hope that phrase doesn't offend somebody out there. I love you redheads, okay? It's just a phrase. But the Apple company was not doing very well for a long time. They had those ugly computers and there was drama with Steve Jobs. They kicked him out of the company and he had to go run another company, and then they brought him back and he was like, okay, the whole company is going to triple down on the iPod, and people thought that was nuts. And so what I'm saying is what's possible and the outlook for the Apple company has changed dramatically. And if you owned Apple as part of a diversified portfolio way back when it was undervalued, then you owned it during its entire uprising, during its entire growth phase. You owned it and you profit from that. Okay. So you owned it even when it didn't look like the outlook for that company was good, because stock prices change on new information. So you got to own the underdogs, right? So I hope that helps, Malaika. I'm transitioning from your question to a bigger conversation about stock market investing because of another question that got asked. So stay tuned because there's more information coming. And the next question, which is from Ina, who's actually one of the 50K Wealth Multiplier Experience clients. She was in that group. She is considering joining Ignite Investing, and she did research on the balanced mutual fund that I selected as the main core only Ignite investment. That fund is by the Dimensional Fund Advisors Mutual Fund Company. It's called DFA Global Equity 1. The ticker symbol is DGEIX. My firm has an exclusive relationship with Dimensional Fund Advisors. You typically cannot buy Dimensional's mutual funds on the retail channel. So they want their funds to be managed and thought about in a particular way. They want you to subscribe to their investment philosophy, which I do. And their funds earn a premium over time. So it's just one ticker symbol, but it's comprised of many underlying mutual funds. It's actually got 5 underlying mutual funds comprising the U.S. core asset class, international stocks, emerging markets stocks, and real estate. So it's a very balanced mutual fund, and it contains 13,500 different companies. So you own a lot of the publicly traded companies in the world that matter. I mean, you own most of what's happening in the world in this one ticker, okay? So that's what Ignite clients have, and this was Ina's question. She basically found a ranking on money.usnews.com that purported to rank balanced funds. The article itself calls them world large stock funds. I haven't actually heard them called that before. I would call it a balanced fund. But anyway, this report puts together some various factors, information about the funds, and then spits out, well, there's a ranking. And as of today, I'm recording this on October 1st, 2018. Oh, by the way, today's my birthday. Recording on my birthday. As of today, the DFA Global Equity Portfolio is ranked 19th. So of course, any normal human being would say, Hilary, when you can pick these other 18 funds, why would you pick number 19? Why would I invest in this? Why is this an advantaged buy for me? So let's answer that question. This is a fantastic question. And to truth be told, in the weeks, it's maybe been 10 days or 14 days since Ina sent me this question, I've been thinking, why haven't I done this before? Of course. So I think this is a great opportunity for you listeners to learn really how to make stock selections, how to make investment selections. Again, I'm not recommending that you do it on your own. This is very complicated, but most of the world looks at investments from a faulty filter. Okay, so first of all, let's talk about the idea of mutual fund ratings. So the devil is always in the details, okay? So when you dig into this, and it's got a really pretty, like a golden seal on the article, it's linked to in the show notes. Everything I've talked about so far and everything I'm going to talk about is linked to in the show notes. It's got a really cool seal. It says Best Mutual Funds, U.S. News and World Report Rankings. That's credible, right? It seems really credible. Okay, well, let's dig into it. So there's a link right here at the top of the article. It said, read the best funds methodology. I want to read the best funds methodology. Let's hear it. Okay, so you click on it, and I'm going to summarize this for you. The methodology of the U.S. News and World Report Best Balanced Mutual Fund Score is they basically take all of the other mutual fund rating systems, and they give them an equal weight, and they combine them and they average them. Okay, so U.S. News and World Report took Morningstar's, CFRA's ranking system, Zacks ranking system, and TheStreet.com. Okay, so, I missed one. The Lipper, there's another mutual fund rating system called Lipper. So it's actually 5 different mutual fund rating systems. U.S. News they did something proprietary to it or whatever, but they've averaged the scores and it spits out a response. Okay. So the validity of the U.S. News and World Report mutual fund ranking system is all a function of the validity, or you could say the ability of the other rating systems to predict future returns. That's what this is all about. So we just talked about with Malaika's great question about Apple stock, and it makes total sense that if you see a company doing a great thing, that their performance should go up. But we talked about that stock prices are actually random, that they're comprised of, I didn't actually say this in my answer to Malaika, but the value of a stock today is comprised of 2 things. 1, the actual value of that company, and 2, investor sentiment. And that's it. Okay. And that stock prices change randomly. So if stock prices can't be predicted, how does it make sense that mutual fund prices can be predicted, right? That's what these rating systems are about. They're about predicting the future performance of a mutual fund. Mutual funds are comprised of stocks which cannot be predicted. This is starting to sound a little fishy, but here it is. It looks credible. U.S. News and World Report. It's red, white, and blue. I've heard of U.S. News and World Report. Well, I have some sad information for you. The national financial news media is not a source of academic or valid research on investing. I don't know how else to say this to you, but the communities of people, believe me, there are a lot of really, really, really smart people have done their very best to look at the past performance of stocks and predict future performance. I promise you, the smartest minds on the planet, I mean, if you think about the kinds of profits that are possible if we're able to predict stock market returns, so I promise you, the best universities and the best academics have put their best brain cells on this problem, okay? And the conclusion is stock prices are random. So this is generally accepted in the academic community. But just like most things, academia is kind of boring, right? There's nothing really sexy or dramatic in academia. And if the financial news media only reported what was academically evidenced or had appeared in a peer-reviewed journal, well, nobody would read the media and they'd all go out of business. Okay. So these like listicles, first of all, most articles about stocks or the stock market are basically useless to you. The financial news media is not a place to get recommendations that you can take action on. These listicles, the rankings of mutual funds, these are just really great fodder for clickbait. They're just clickbait. They get people to click. It's interesting. Unfortunately, unsuspecting investors make investment decisions based on these rankings. And, unfortunately, they lose money. Well, I essentially said to you, we can intuit that mutual fund rating systems are not valid because we can't predict the future movement of stock prices. So how can we predict the future movement of mutual fund prices? Well, let's actually talk about some of these in specifics. So first of all, I think you should not even attempt to get your investment advice from the major national news media. This is, like I said, I have been reading these articles for so many years, and I am so disillusioned with the major publications. It actually really makes me struggle in some other areas of my life because I do have enough experience in investments to know what I'm doing. But let's take nutrition, which is an aspect of life that actually has a lot in common with investing. So there are lots of inputs. There are mixed outputs. We're not really sure. Like there are schools of thought, people who say one thing, but for any one thing that one expert says, you can find an expert to contradict. That's very much like investing, right? So, but I don't believe what I read in the major publications. I believe that in order to really know the truth as far as we know it, you have to read the academic peer-reviewed journals. And I'm sorry to say, you just can't trust that. Like the news media is great when it comes to things like breaking news or, complex current event stories. But when it comes to reporting on something that we at this point have 90 years of data about the stock market, there is no new news. There just isn't any. So when it comes to topics like this, I just don't think it's credible. So let's talk about some evidence I would give more credibility to. Here's an article, again, linked to in the show notes, published by the BAM Alliance. This is an alliance of independent financial advisors by a gentleman named Larry Swedroe. Here's just a little bit of Larry's credibility. Okay. When you're reading articles about investing, you have to understand the author's vantage point. What are they trying to do? If it's a staff writer at U.S. News and World Report, that's clickbait. Okay. People who write about investments have to know about the investing landscape, about the world of research that's been done. They really should be academics. So here's Larry's credibility. Director of research at Buckingham Strategic Wealth. He was among the first authors to publish a book that explained the science of investing in layman's terms, the only guide to winning investment strategy you'll ever need. He's since authored 7 more books. What Wall Street Doesn't Want You to Know, Rational Investing in Irrational Times, The Successful Investor Today, Why is Investing Made Simple? Why is Investing Made Simpler? The Quest for Alpha. Alpha, by the way, is the ability to outperform a benchmark. And then Think, Act, and Invest Like like Warren Buffett. That's just part of his bio. He holds an MBA in finance and investment from New York University and a bachelor's degree in finance from Baruch, Baruch College in New York. Okay, so maybe his undergraduate institution is not that impressive. Larry Swedroe has a lot of credibility in this industry. Okay, here's his article called The Peril of Chasing Active Mutual Fund Performance Ratings. So essentially what he's saying is the peril of using articles like the one Ina, unsuspecting, totally normal to do is click on an article like that and think because of the source has credibility in the world that the article has credibility. But this article basically says it's not a good idea. Okay. I'm just going to read little quotes from this article. To date, an overwhelming body of academic research has demonstrated that past performance not only fails to guarantee future performance as the required SEC disclaimer states, but has almost no value whatsoever as a predictor, with the exception that poor performance combined with high expenses predicts future poor performance. Number one predictor of future poor performance is high costs. And by the way, some of the mutual funds on this U.S. News and World Report article that come before the dimensional ranking that are ranked at 18 to first are what I would call high cost. Another quote from the same article, the bottom line is that past performance's only value seems to be in showing that poor performance tends to persist, with the likely explanation being high expenses. Okay, here he does an analysis. It's the same article, but now he's analyzing an article from or a paper written by a couple academics named Parwada and Tam called Superstar Fund Managers, Talent Revelation or Just Glamour. Okay, quote, the authors examined the performance of funds managed by the winners of Morningstar's coveted Fund Manager of the Year award. Morningstar selects its FMOY winners based on expectation of future alpha. So again, alpha is the ability to outperform the benchmark. Skipping a little bit, quoting again. The medal rating indicates that our analysts believe a fund will outperform its category peers and or benchmark on a risk-adjusted basis over the long haul. Looking at their individual coverage lists, analysts nominate Morningstar medalist funds that have a strong recent and long-term risk-adjusted returns, excellent stewardship practices, and broad shareholder bases. So this is the Morningstar organization talking about how they pick their manager of the year. Now, you know the Morningstar ratings are the most well-known mutual fund rating system out there. And this is them describing their premier award, their Fund Manager of the Year award. Okay. So here is these academics, Parwada and Tan, did a statistical analysis of the efficacy of the award. So once they give the award to the manager, does he or she outperform over the 3 and 5 year period in the future? That's what you want to know, right? If I go buy the mutual fund that these guys say is the best managed by the best mutual fund manager in the world right now, am I going to get higher performance? I bet you can guess the answer. Ready? They confirmed that investors respond positively to mutual fund managers who win a prominent Fund Manager of the Year award based on a proven long-term record. FMOY winners garnered 21% more assets over the 12-month period following the award announcements. No surprise there. Here we go. Award-winning managers generate positive risk-adjusted performance in the very short term. FMOY winners generated outperformance of 1.6% for the 3-month period following award announcements using the Carhart 4-factor, which is beta, size, value, and momentum model. Okay, sorry, there's a little Wall Street speak in here, guys, but these are the papers you need to be reading. Back to quoting. However, that outperformance disappeared when measured during the subsequent 6, 9, 12, 24, and 36-month periods. The results were statistically significant at the 1% level of confidence. So basically, FMOY mutual fund managers outperform for 3 months, 90 days, to the tune of about 1.5%. And then after that, they actually underperform. Another section of this same article by Swedroe, the November 2009 issue of Morningstar's Fund Investor provided the following evidence on its 5-star funds. Okay, so they're going to go back and analyze their class of funds that in 2004, 2005, and 2006 got 5-star ratings. The 2004 class of 5-star domestic funds had a 5-year rating of just 3.2 stars, just slightly above average. The average fund underperformed its risk-adjusted benchmark by more than 1%. So let's just say this in English. The folks that Morningstar said were the best of the best in 2004, over the next 5-year period, their average mutual fund rating slipped from 5 to 3.2, and they underperformed their benchmark by more than 1%. So you'd be better off just buying the index fund. The 2005 group of 5-star funds turned in a 3-year rating of just 3.1 stars, and the 2006 group had a 3-year rating of just 2.9 stars. This goes on, folks. Philip and Kinnery concluded higher ratings in no way ensured that an investor would increase his or her odds of outperforming a style benchmark in subsequent years. In fact, they found that 5-star funds showed the lowest probability of maintaining their rating, confirming that sustainable outperformance is difficult. This means that investors who focus on investing only in highly rated funds may find themselves continuously buying and selling funds as ratings change. Such turnover could lead to higher costs and lower returns as investors are continually chasing yesterday's winner. The bottom line is that using Morningstar ratings to identify future outperformers is like driving forward while looking through the rearview mirror. Their rating system does a great job of predicting the past. That applies to not just all rated funds, but even to FMOY winners. Moving on, this is an article from Forbes. Okay, so Forbes is not normally a site that I would source. And the article is David John Marotta. He's a financial advisor. He's prolific. He writes a lot. He went to Stanford. He's a smart guy. Okay, but what he's doing is he's quoting Russell Kinnell, the director of manager research at Morningstar. So this Kinnell says, if there's anything in the whole world of mutual funds that you can take to the bank, it's that expense ratios help you make a better decision. In every single time period and data point tested, low cost funds beat high-cost funds. Expense ratios are strong predictors of performance. In every asset class over every time period, the cheapest quintile produced higher total returns than the most expensive quintile. A quintile is a 25%, obviously. So what they're saying is if you can buy mutual funds in the lowest quintile of expense ratios, you are likely, you have the strongest predictable chance of beating the performance of the other mutual funds, especially the ones in the highest quintile. Buy the cheapest, don't buy the most expensive. This quote is from David Swensen. It's in the same article in Forbes written by Marotta, but it is from David Swensen. David Swensen was the manager of the endowment, or is the manager of the endowment at Yale University, and made a real name for himself, investing that endowment and producing alpha. So Swensen says, because Morningstar fails to realize that information on past performance provides precious little advantage in the hunt for superior future performance, the firm's regular attempts to tweak its rating systems hold no promise for success. So look, ladies and gentlemen who are listening, I haven't talked about the other 4 rating systems that the U.S. News & World Report uses. However, I think, again, we can all agree that Morningstar is the most well-known and frankly, the most well-adopted. I get people in my office all the time, very smart, very wealthy people who ask me about the Morningstar ratings of the mutual funds that I use. And I have to tell this story again and again and again because Morningstar has perpetrated such a falsehood on people, but through this, I think that they capitalize on the same normal human emotion that, Malaika reached out when she saw the news about Apple and she thought, well, this must mean that potential for future returns are greatly expanded. So the Morningstar organization and these other mutual fund ratings organizations, in my opinion, have perpetrated a great falsehood on the average investor. My basic argument is that if I can prove to you that the Morningstar rating system doesn't have validity, which I believe I have, then I have proved by proxy that the other 4 rating systems that this U.S. News & World Report ranking system are using also don't have validity. And therefore, of course, the article itself has no validity. Just look at the number 1 mutual fund in this article, Morgan Stanley Institutional Global Opportunity Portfolio. It's MGGPX. Number one, according to this ratings article, expense ratio is 1.32%. That's 1.32% just to own the mutual fund. The expense ratio of the DGEIX mutual fund is just 0.3%. That's a huge discount compared to the Morgan Stanley fund that U.S. News and World Report says is number one. And we just said the best predictor of low future returns is high costs. I give absolutely no credibility to this ranking system. And I know that flies in the face of what you think would be intuitive. Let's talk about how I would recommend analyzing your mutual funds instead of this way. Okay. So instead of basing your investments on past performance of individual stocks, let's talk about what we know about the performance of different stock categories. So, for example, over the last 90 to 100 years, the U.S. large asset class, which has had individual companies move in and out and in and out and in and out of it. Understand the company itself has to have certain characteristics to be considered a U.S. large company. But over the last 90 to 100 years, the U.S. large asset class has performed at an internal rate of return, a nominal rate of return of about 9.5% to 10%. So we basically expect that asset class to continue to perform at 9.5% to 10%. Now we have all this data on all the other kinds of asset classes too. Every kind of company, you can divide them geographically, you can divide them by industry, right? And then the first company to market with this kind of investment philosophy was the Vanguard company. John Bogle took seminal research that was done in the field of finance and investing by Gene Fama and Ken French called modern portfolio theory. He said, oh my gosh, everything we're doing on Wall Street is wrong. Everything we're doing for investors is actually serving us, the broker, and not them, the customer. And he said, let's do it the right way. Let's just basically buy a whole bunch of different companies and hang on for dear life, like not sell. But of course, John Bogle was laughed off Wall Street because the Wall Street mutual fund managers and brokers were making big profits. So Wall Street and Vanguard were divided. And John Bogle was the first one to say, let's do things the right way. And he built a great big company. And frankly, he could have made a lot more money doing it. But his value proposition is low cost and market-based investment philosophy. So if I had not selected a Dimensional Fund Advisors mutual fund, I would have picked a Vanguard fund. Probably. There are other companies out there doing it, but Vanguard really is the flagship and number one company doing index-only investing. Dimensional Fund Advisors provides a value add on top of index funds. DFA, which was actually founded by the guys who did that research that John Bogle used to found the Vanguard company. Their names are Ken French and Gene Fama. So the Dimensional Fund Advisors company was founded by the academics who did the research. And they said, hey, we're not going to call ourselves an index fund, because if you're an index fund, you have to mirror the index, which means when the index makers come out on their announcement day and they say these 10 companies are off and these 10 companies are on, well, every index fund company has to trade those stocks on that day, and you pay a huge price. Imagine what it's like if you own something and you have to sell it that day. Well, intuitively you're going to take a hit on the price. And imagine what it's like if you have to buy something that day. It's the same thing. You're going to sell the thing you have to get rid of for less than it's worth, and you're going to buy the thing you have to buy for more than it's worth. And the holders of index funds suffer those costs. Okay. There are other technical advantages of owning DFA funds, but in my opinion, that's one of the major ones. Not only that, but they're such a large company that they are able to wait for advantage pricing. So even if there are times when trades are delayed to make sure that they take advantage of large purchase quantities and pass those savings on to their customers, their investors. And as a result, most of the DFA funds beat their risk adjusted benchmarks over the longest time periods. And I'm going to put a link to a graphic in the show notes for this article to show you that. It's tough to talk through a chart. That's why audio isn't necessarily the best medium for investing data. Okay. I do a lot of this stuff with people in my office, but that is basically the reason that I choose to work with dimensional fund advisors. All of my personal retirement savings is in this investment philosophy. It's the same holdings, okay? Some of my accounts have the DGEIX ticker. Some of my accounts have a more diversified portfolio, but this is how I'm invested. And if DFA didn't exist, if my firm didn't have a relationship that allowed me to buy those mutual funds on behalf of myself and my clients, I would work with Vanguard. And so I hope that helps you understand why I've picked the DGEIX fund. I truly believe it's the best opportunity for Ignite clients really in the world. That's my belief, is that this fund is the best and not based on recent past performance. I don't care what the performance was last year or the year before or the year before that, because I know the long run internal rate of return of each asset class in that mutual fund. And I know how it's balanced, and I expect that those returns will be the best for you as an Ignite client. Now, a little sidebar, many of you who are Ignite clients or who have considered being Ignite clients know that I've picked a balanced fund that doesn't have any bonds in it. And that's why we say that Ignite is for you during your saving and investing years. So at a certain point, it's just no longer appropriate for you to not have bonds. The purpose of bonds in the portfolio is to dampen volatility in the portfolio, which means during bear markets, you're not going to have those low lows. You're also, during bull markets, not going to have the high highs. So you stay a little insulated. It's like a little bit less of a bumpy ride. That's what bonds do in the portfolio. Ignite clients have no bonds. Okay. So when it's getting close to the time period when you are going to need that money because it's 10 or so years from your retirement, well, we're going to layer you out of a no bond portfolio and into a portfolio with more bonds. That's all. Okay. In summary, stock prices movement is unpredictable. We don't know where individual company prices are going to go, and we certainly don't know where mutual fund prices are going to go. Okay. Rating systems don't predict future performance. Instead, a better way to predict future performance is to make sure you get an investment that has pricing in the lowest quartile of mutual funds. Okay. I don't recommend that you get your financial advice from the major financial news media. Instead, you could be reading the academic journals, or you could just listen to Profit Boss Radio, and I promise not to guide you astray. There's a lot of intellectual capital behind why I selected the DGEIX mutual fund. I firmly believe it's the best one for Ignite clients. If you're considering being an Ignite client and you make it through the application process, in other words, it's not the right investment for everyone, but I firmly believe it's the right investment for you. I truly hope this has not been too technical of a conversation. But I think it's important that you know that there's a lot of reasons and intellectual capital behind these choices. So again, like I said in the beginning, please don't take anything I said, not one thing in this episode of Profit Boss Radio, as a personal recommendation for your own investments. Do not go buy anything because of anything I said today. I have not considered you, your individual needs, your time horizon, or your risk tolerance. So don't consider anything I said to be customized personal investment advice today. All right, Profit Boss, please let me hear from you at media@hilaryhendershot.com. Let me know if this was helpful, if you enjoyed it. If you have further questions, I'm happy to answer them in future episodes of Ask Hilary. Wanted to say a warm thank you and welcome to our new clients. In the last 6 to 8 weeks, I haven't done this for a while, so it's John and Margaret, Pri, Leslie, Alan, and Ina. Thank you so much for your trust and for your business. I'm honored to do business with you. Little update about Profit Boss Live. So last year at this time, we were in full swing getting ready for Profit Boss Live. And so I just wanted to let people know I will not be offering that event again this year. It may be that was a one-time event. Instead, I'm going to wrap all that content into the first day of the 50K Wealth Multiplier Experience Coaching Program, which I will be launching in the spring of 2019. I'm only going to offer one cohort in 2019. Honestly, last year I spent probably the better part of 6 to 8 weeks getting ready for Profit Boss Live. And given what's happened with my daughter, if I was preparing for Profit Boss Live again, I think I would have lost my mind. So while I loved the day and the event and everyone who came was magical and amazing, I am so grateful that I was not planning to do that event again this year, because I just would have, I don't even know how I would have reacted. So I'm sorry, but no Profit Boss Live in January. Again, all that same personal finance and investing and tax content will be included in the first day of the 50K Wealth Multiplier Experience, which I will continue to talk about until we open registration. So stay tuned for that. I also have a very special invitation for you to contribute to Profit Boss Radio. The year 2018 is rapidly winding down, and I really want to put together a very special episode that celebrates you and us and our wins, and I need your help. So if you have crushed a specific financial goal, I want to hear from you. If you're thankful for something that has happened in your financial life or career, I want to hear from you. If you are making big plans for 2019, I want to hear from you. We all benefit and are totally encouraged when we hear about how women just like us are changing their narrative with money and doing things they never thought were possible. The truth is, your financial success is possible, and so many of you are already making that a reality. So don't keep your wins to yourself. Share them with me so that I can share them with the world. I will be airing a special year-end episode of Profit Boss Radio as a tribe of smart, capable, powerful women who talk about our financial wins. We express thanks and gratitude for important changes in our financial journeys, and I'm really looking forward to a new year of financial and professional progress. I'd love for you to join me in that. So email your audio clip to media@hilaryhendershot.com, and we'll be in touch if we plan to air your story in a few weeks. Thanks, ladies. I hope you enjoyed this episode of Profit Boss Radio. If you have a financial question you want answered, be sure to send it to me. Pick up your mobile phone right now. Yes, right now. Open your voice recorder app. Go ahead and open that app and record yourself asking me that question. Just say your name, first name only is fine. Just what city you're from, and then ask away. Anything you want to ask. And when you're done recording, export that beautiful little question and email it to media@hilaryhendershot.com. That's media@Hilary, Hilary, Hendershot, HenderShott.com. Have you subscribed to my email list yet? I know you're probably subscribed to Profit Boss Radio on iTunes or elsewhere, but you have to get on my email list so that you don't miss special announcements, exclusive listener giveaways, bonus content, and more. I promise I never send anything spammy. So hop on over to HilaryHendershot.com and be sure to subscribe to Profit Boss Weekly. Oh, I almost forgot. Get your hands on my 7 Steps to Wealth guide. It is completely free, and it's in the same format you already prefer, audio. I literally walk you through each of the steps I talk about to help you grow your money and reach financial independence. And I even follow up each step with an accountability email to keep you on track. I'd love for you to go get your copy. Even if you've listened to the 7 Steps to Wealth episode on Profit Boss Radio, this has brand new, unique content and learnings, and then you can share your progress and feedback with me. Remember, by day, I'm a fee-only fiduciary financial advisor helping high-earning, powerful women just like you apply all the lessons and tips I share on this show all around the country. So if you're a fan of the show and you want more, be sure to visit my website, HilaryHendershot.com, subscribe to my mailing list, get your copy of 7 Steps to Wealth, and reach out to me to explore working together. I'm only an email or a phone call away. To your prosperity, ladies, I'm your host, Hilary Hendershot. Bye for now.